Hi, and welcome to the week ahead. I'm Tony Nash. Today we're joined by Bob Iaccino. Bob is with Path Trading Partners. But we're also joined by Josh Young. Josh is with Bison Interests. And we're with Tracy Shuchart, who is with Hightower Resource Advisors. Guys, thanks for joining us today. And Bob, I know this is your first time to join us, and I really appreciate you taking your time. I'm always really shocked by the quality of people who will talk to us, which is just amazing. So it's great to have you here. And Josh, this is your second time, and you have just hit a lot of home runs since your fund started. I think you're up 140% or something, while the industry index is down like 20% or something. Is that right?
I can't talk about my performance.
Okay, so I think you're doing pretty well. So I'm just really really grateful to have you guys here. We've got a few key themes here. Of course, there's been a lot of macro data out, and some of that stuff has been classified by a few people as kind of widowmaker trades. So let's get a little bit into that with Bob. We're going to look at energy and inflation, and Josh is going to lead on that. And then we'll look at WTI and the SPR with Tracy. So Bob, let's start. You had sent this tweet out from Emma a few days ago, where she says that markets kind of are believing what they want to believe, and it's really a trap, and some of them are kind of widowmaker trades. So can you talk us through that? Of course, we just had the big Fed meeting with a 50 BPS rise, and JPow now insists that the terminal rate is 5.5 or somewhere around there. We saw PMIs come out today that were a lot lower than expected. We saw a downward revision in unemployment by over 1 million jobs. Of employment by over 1 million jobs. So why do markets continue want to see a rosier picture, or what are we where are we right now, and where is it going?
Well, it's interesting, Tony. And again, thanks for having me. When you're looking at equity markets specifically, okay, let's just talk. When we talk about markets in a general sense, we're usually talking about equities, which is one of the things I think the mainstream gets wrong. But when we're talking about equities, you're talking about just a natural upward bias. There's many millions and billions of dollars that go into 401ks and long-only mutual funds every single month that people don't even look at. So when all else is equal, you have a slight upward bias in equities. And therefore, it kind of stands to reason that people in general, investors, retail investors, want things to go up. And I suspect when somebody starts trading, I remember I gave a speech pre-COVID, and somebody came up to me and said, I don't understand how you trade the ES, which is the S&P futures. I said, what do you mean? They said, well, stocks always go up, right? So sometimes you can be short the ES. And I'm like, oh my Lord, let me show you a chart. Stocks don't always go up. If you take a look at an equity chart going back to 1920 or however long you want to be, yes, it is angled this way. But when you see what's going on right now, there's a lot of old adages in the markets that I honestly can't stand, but one of them that gets repeated a lot is you can't fight the Fed. And most people are trying to fight the Fed, and Jerome Powell keeps coming out there and says, why are you guys fighting me? So the more and more stern Jerome Powell gets about interest rates, the more and more the markets get comfortable with what the Fed is doing and saying sort of, and I'm paraphrasing what I think the market would be saying as a whole, okay, we know what you're doing now, so we're comfortable with it and we're just going to buy stocks. And that seems to me to be troubling. It's interesting because I'm bearish medium to long term, but I own the S&P futures right now. I actually bought them on the first day of the fourth quarter with a mindset toward this type of activity. I said, okay, the fourth quarter is going to be higher than the third quarter. So I can go ahead and buy a small ES position within the context of my thesis that toward the end of the first quarter, beginning of the second quarter, I think equities dump again. I don't think that the lows that we saw in October are the ultimate lows for this particular bear market.
So you're saying that selling out of Trump's NFT doesn't mean we've hit the bottom yet? Like selling out of like yesterday day or whatever?
I took screenshots galore of that Trump Superman thing with the laser. I'm like, if he could have a body like that, so can I, right? By eating McDonald's and drinking Coke. I thought that was amazing. Yeah, no, I mean, again, these kinds of things, a lot of people would think is peak bullishness just in any market overall. It certainly is probably peak bullishness, at least in the short to medium term in NFTs, that happened.
Hi everyone, wanted to let you know about a promo we're having for our CI Futures subscription product. This is our Inflation Buster sale. We know that prices are hitting you everywhere and it's holiday time, so I want to give you a big break on our CI Futures product. CI Futures has thousands of assets that we forecast every month. We do commodities, currencies, and equity indices every single week on Monday morning. There are hundreds, almost 800 of those that we forecast every week, updated on Monday morning. We forecast economics variables every month. Those are available on the first of every month. In total, it's thousands of assets. We show our error. We're the only product out there, the only forecasting product out there that actually discloses our error. You can see our historical error and you can see a year's forecast at monthly intervals. Right now, we're offering 50% off of CI Futures. You can actually get it for as low as $25 a month. We have different arrangements based on the commitment you want, a full year or say going month to month. So you can get it anywhere between $25 a month and $50 a month with our current offering. So please check it out. Please click on the site. If you need a demo, let us know. Thanks very much. So why do you think we'll continue to see ES rise through, say, first quarter? Like, what are you seeing? Is it sentiment or is it some of the data coming out?
It's the data being done and it's the big events being finished. So again, as I mentioned at the beginning of this conversation, Tony, all else equal, equities have an upward bias. And I said to myself, okay, we've got one more Fed meeting, one PCE, one CPI, a couple of small to medium-sized business PMIs in the form of the S&P PMIs, and then not a whole lot. So given that backdrop, people say, okay, we're still near enough to the lows, or this is probably the lows. Even some of the people that I respect a lot think that the October lows are the lows, and I just happen to disagree with them going into next year, but they're likely, this is not a bold statement, the lows for 2022. I mean, that's not a very scary thing to say, considering we've only got, 10 trading days left, 20 trading days left at the most. So from that perspective, I feel very comfortable with the buy at the end of the third quarter and sell somewhere near the beginning of the first quarter position that I put on, and I have a break-even stop. I mean, I'm not going to lose money on this trade, which means I'm not going to pay a whole lot of attention to it anymore.
Right. Okay, very good. So Josh, let's talk about the data for a minute. Josh highlighted a chart that was sent out today looking at the difference, say the divergence between hard and soft economic data. And hard economic data is still relatively positive. Significantly more positive than the soft data, so can you help us understand what's the difference between hard and soft data? And then what's your view of the divergence between hard and soft data?
Yeah, so I focus more on sort of the energy side than the general broader market data side. But it is interesting. So the hard data, and my understanding of this is the measures of actual activity, and the soft data is more measures of sentiment or sort of modeled or forecast activity. And then I guess where I sit on it is I'm looking at actual oil and gas consumption data, and it looks a little weak. And so when I look at it looking a little weak, and that doesn't mean I'm bearish. I like the supply situation a lot. It's very bullish, and that probably overwhelms. But from my perspective, tracking oil and gas consumption, it looks like maybe some of this ostensible hard data isn't as hard as it's represented. So that's sort of my take on that.
Let's talk about that a little bit. Bob, you seem to be a little bit skeptical of some of the hard data. What do you think is a little bit overstated right now?
Well, I'll give you an example. This past non-farm payrolls report, negative 40,000 on retail jobs. When have we seen that going into a holiday season? It's likely that a lot of it has to do with seasonal adjustments, in my view, because how do you correctly adjust for seasonality that changes every season, along with technology changing every single season at a rapid pace, what seasonality may or may not look like? So, I'm not a conspiracy theorist by any stretch of the imagination, but hard data produced by the government is where there is possible manipulation. I'm not accusing anyone of manipulating anything. I'm just saying that's where it's possible. In sentiment data, that is the survey respondent's sentiment. That's what it is.
Right.
And that generally shows up in hard data. You know, Josh mentioned in his tweet about this divergence between hard and soft. Right now, we have a divergence between iron ore and crude oil prices, right? Which has a very positive correlation over time. We can look at the data, Josh can look at the data, and so can Tracy better than I can, and say, okay, I believe these will converge, and I think this one will lead because it's data. Sentiment, you can't say that's not the respondent's sentiment, whereas data coming out of the government, if you believed the government's data isn't manipulated, then the data is what it is. But when you look at something so strange as retail employment falling going into the holiday season, that's either economically catastrophic. Is that a word? Catastrophe?
Sure, catastrophe.
An economic catastrophe,
Catastrophic.
or it's wrong.
Yeah.
One of the two. Catastrophic. That's what I was trying to.
Well,
That's right.
and we have all these huge revisions in the employment data every month, right? Going back, you know, they'll revise 2-3 months back. And so, you know,
They'll revise 2 years back, Tracy. Like, there are generally 4 revisions on OECD country data. And so, you know, they'll go 2 years in and revise stuff. And, you know, whenever I see an initial kind of print of economic data, I always say, and you see this regularly on Twitter, is I say, I'll wait for the revision. And it's not the first revision, it's typically the second or third revision. My view is that the first two, say the initial print and the first revision, are really PR for every macroeconomic print, not just in the US, globally. And then, you know, we start to kind of see back adjustments of what really happened. So, you know, I just don't understand why initial prints of economic data move markets. I don't understand why the financial media make a big deal about these initial prints of data, because they're wishful thinking. In the same way Bob was talking about how investors have a rosy view of stocks always going up. You know, macro data typically has the bias of those government statisticians, either too negative or too positive. So, okay, good. So is the view, guys, that the soft data will pull the hard data down? Is that kind of where we're kind of falling on this?
It's definitely my view.
Okay.
I mean, again, if that's your sentiment, something has to happen to flip that sentiment. You know, I always like watching the politicians. You know, I don't make political statements on shows like this. I make political statements, unfortunately, at the dinner table. But when you're talking about political statements, you'll see, you know, jobs are strong and you're making enough money to pay for the inflation. That doesn't change the reality on the ground for people.
Oh, no.
And you're not gonna actually have somebody say, well, the president said I have the money to pay for this, so everything is fine. So
Right.
I always believe that the sentiment is much more reliable than the data, even though it shouldn't be that way. You know, it really should be the opposite. You know, Josh runs a fund and he can't talk about his performance, even though the performance is real data. That's what his performance is.
Right.
You know, I was at a fund of funds years ago. As a part of the investment committee. We had 9. Full disclosure, it was a low volatility fund.
Mhm.
So our biggest up year, okay, was about 90 basis points. But we never had a down year. And I'm sorry, 3.9 basis points, 390 basis points. But we never had a down year in 9 years. And our auditors and our regulators said we couldn't publish that performance. And when we said why, they said because it implies that you can't have a down year. Well, yeah, if you're stupid, it implies that.
Right.
But, you know, this was our actual performance, but we can't put it forward. Josh has great performance and can't talk about it.
Right.
And this is the same kind of thing where, to me, the sentiment will pull the actual data down, and then you question whether that's going to be manipulated for political gains or not by either side.
Right, exactly.
So that's
This
the
is not
worrisome
one party
thing.
or the other. It's both parties.
Absolutely.
We're
I
not
think
putting figures at anybody individually.
I mean, I think the employment data's been wrong all year for 2 years now.
Right.
I mean, you just look at labor force participation rate and how many people are, you know, multiple job holders, not, you know, single job holders. So
Right.
I don't know.
So
And we just had that huge revision of a 1.1 jobs.
yeah, so we saw JOLTS turnover a couple weeks ago, and then we had this downward revision of jobs. So if we look at the Fed's mandate, they're kind of not really doing either, right? Either they're not doing either, or they've already achieved the job stuff, which they said 6 months ago that they hadn't achieved, and they continue to persist that they haven't achieved. So is it fair to say that with the downward revision in employment data and the downward trend in JOLTS data that they're kind of getting there already? So this is kind of a bad news is good news thing, potentially?
Potentially, if the market chooses to read it like that. I don't think the algos know how to read it that way. But yeah, I mean, it's possible we already are at 4.5% with all these revisions, unemployment. So
right. Okay, very good. So we're going to get off the macro data for a minute. We're going to move to energy prices. Actually, we're going to stay on some macro data for a little bit. I put on the screen our complete intelligence CPI forecast. And what we're looking at potentially is a gradual rise of CPI through, it accelerates a bit in April and goes into the summer. So it's possible, according to our forecast, that that we do see a second bump in CPI. I have to say there is no human intervention in this. This is all machine driven. And so, we're reading things in the markets, or the machines are reading things in the markets that are saying we could see a second bite of inflation coming in, say, end of Q1, early Q2. So, Josh, the question for you is, we've seen some weakness in crude prices, and consumers are seeing a bit of break with energy prices, gasoline prices, and so on. But we saw from the Fed meeting that JPow doesn't see inflation abating anytime soon. So it seems like it'll be fairly persistent. How do you expect energy prices to fit within that? Are you seeing energy prices accelerate quickly, or do you expect energy prices generally? Of course, I know there are different segments, but generally, do you expect them to kind of accelerate quickly, or do you see kind of a delayed acceleration of energy prices?
So this is a great opportunity to run real briefly a potential economic analog to where we are in some respects. And the potential economic analog is the Asian financial crisis, the 97-98 scenario. And where that might be real similar to what we're seeing now is, one, we're actually seeing consumer deposits start to fall with loans increasing. We're seeing mortgage rates start to fall, even though the Fed reset or keeps raising rates. And so we're seeing the housing market start to clear. And then we have this very low labor force participation, sort of similar to what you saw in prior periods. And you see this, they say, what is it, that good times lead to weak men, and then weak men lead to bad times, and bad times lead to strong men. And, sorry for the gender aspect of that, but just sort of the general idea.
People.
When I see all this, I think that there's a real chance that we see much higher consumption of real goods and real inputs, and then when I tie that, so that's relevant for the inflation question as well as for oil and gas in particular, because there's this huge non-participating aspect of the labor force that is increasingly likely to participate as NFTs and crypto and various day trading, tech stock, and other sorts of speculative activity comes down. And then, there is this other aspect, which is that, with oil and gas starting to come into China more, and other commodities potentially coming into China as they reopen and re-stimulate, there is the potential for inflation on raw materials and deflation on consumer goods and other stuff that China exports. And so it's a sort of very weird, messy time. I'm not sure I think that tech equities rebound like they did in that after that 97-98 timeframe. But other than that, I sort of, it looks like sort of the most similar to maybe that plus 2003, something along those lines. And I'm interested in your guys' take on that, because it seems like we have room actually for significant uptake in demand, not just in China for oil and gas, even in the US potentially, as employment potentially improves, just because you have all these people, you have all these open jobs still, especially on the low end, and you have a lot more people who maybe are relevant for those jobs and more interested in them now.
Yeah, so when you talk about uptake, so if we look at China, for example, there were 0 international flights going into China from, say, 2020 until, this month, right? Something like that, international tourist flights. And those are restarting. And so that's just one kind of proxy indicator of, say, trade, the economy, travel, other things, right? So do you have a view on that, on say passenger flights into China, tourism in China, and how that would impact, say, crude?
Yeah, so I have a better view on China to China flights than
Okay.
China to international. It actually does look like there's a lot more bookings for international to China and vice versa flights, but there's not a lot more actual flights yet. But there are way more China to China flights. We're actually up from a low of 2 weeks ago or 2.5 weeks ago. We're up about 100%. Actually, maybe even more than 100%. And again, like the data is not perfect, but I've been posting daily 7-day average lag data just to sort of show a moving average, and the moving average is up over 100% for that. So just those China to China flights, it looks like represent about 200,000 barrels a day of jet fuel consumption. And jet fuel is very oil intensive. You use more than a barrel of oil to get a barrel of jet fuel because of the energy component and because of various other aspects of that refining process. And so also, jet fuel consumption historically has been a good proxy for oil and gas consumption in an economy. You're going to use, if you're using more jet fuel, you're using more gasoline, you're using more diesel, you're using more coal and natural gas and various other things. It's a great sort of real-time economic proxy. And there's lots of, this is one of the places where I disagree on the sentiment surveys. I'm an economist and by training and education. And the problem with surveys is that there's no money in them, right? So people just tell you whatever they think. Whereas consumption is actual money. It's a buying decision. It's not a speaking or a writing decision. And so the consumption matters more. So these real-time actual consumption indicators are very promising, it looks like, from China, even as there's headlines of, oh, Beijing is totally shut. So the headline is that, and then the consumption data is that the consumption is way higher. I'm going to go with the consumption data. And that looks very promising. Again, that's only part of this theory. And I'm interested in your guys' take on it to the extent that you're open to talking about it.
Well, they also, Bob was talking about iron ore earlier, and they came out overnight actually and said they have a state buying, they purchasing iron ore is how they purchase it now. They started about a year ago. And so they said they're going to start buying iron ore again. So really, to me, that does say they are really getting ready to sort of push this stimulus. And, they really want that 5% GDP for next year because of all, because of how much it has come down and how much it's been lagging over, the last 2 quarters, including this quarter. So to me, you're seeing hints, not that just them saying no more COVID passes, I'm looking for real things that they're actually doing. So, look for them to start buying, hard assets and buying sort of in the material sector. And that's kind of, to me, says, okay, we're ready to stimulate this economy.
Okay, that's fantastic for everyone, right? Like, no, I don't think anybody in the world wants China to fail because it hurts everyone. There's such a big economy, and especially their Asian neighbors, but also their big trading partners like the EU and the US, right? So I hear a lot of kind of sour China sentiment and people kind of cheering China failing. And I don't think anybody in reality wants that to happen because it would hurt all of us. So since we have 3 energy experts on, I guess, let me ask you about China's position with their crude reserves. Are they pretty tight? Do they have a lot in storage? Do they have stuff contracted? Like, if they grow, how will that impact the spot price?
Well, they will have to buy more because when oil prices were at their peak, just a few months ago, even though they were close, and, even into 2021, when oil prices really started to spike higher, they used a lot of their SPR, especially starting in summer of 2021. So they started using a lot of their SPR because, well, they like cheap commodities and oil prices were spiking. And so I do know that, from what we can tell, you have to remember, we only know what's above ground that we can see by satellite. We have no idea what's underground for what they have in storage. I just want to preface that because a lot of people say you don't know what type. So we do know some storage. So what we can see is that they have drawn down their SPR quite significantly. And so if they start opening up and they need to purchase more, especially with kind of these oil prices lower and then being able to strike deals with Russia right now, I do think we'll start seeing them purchasing a lot more, not just for consumption now, but to refill their SPR.
Yeah, I suspect, well, again, I mean, I'll defer to Josh and Tracy more about China. I'm actually much more knowledgeable about Japan than I am about China, but from a perspective of what they're likely to do, there's the interesting sort of component of Chinese culture can be quite monolithic. And if you have sort of spikes in COVID cases, and it brings about this sort of, I mean, they obviously protested lockdowns, but, there were reports overnight about Beijing looking like a ghost town today because cases were spiking again. And you could see this potential sort of spike in demand and then drop off in demand. And that would likely be the last drop off, where I suspect that the demand that we saw here in the US, China's demand would, increase 3- and 4-fold of the spike that we saw here in the US, which is why I kind of agree with Josh's overall bullish sentiment, even though we haven't quite reached my downside WTI targets that Tracy and I talked about a couple of weeks ago. From that perspective, though, there is an interesting possibility of this downturn. But to Tracy's point, I don't think the Chinese government stalls their purchases because of their SPR usage. It's called an SPR globally, but they certainly use it quite a bit more than we do here in the US to manage it's almost like a hedge account for them, where they sort of buy and sell much more rapidly and store. And they do the same thing with copper. And it's interesting because when the copper market started really getting in the headlines and spiking 3 years ago, there was all this talk about copper inventory and copper being used as a currency in China. But you can store copper for quite a bit longer than you can store fresh crude oil. It's got to be rotated. So
that's a great point. That's great. Okay, so speaking of SPR, Tracy, you pushed out a chart this week on WTI versus SPR, WTI price versus SPR. And it looks like that divergence is pretty stark. So you guys just mentioned China drawing down their SPR. The US has drawn down its SPR. So can you talk us through what this chart means and really what it means for crude prices?
I mean, really what it's showing is, it's showing all of the times that we've pretty much needed to tap into the SPR because of an actual emergency. And so you can see the difference between when we had to, tap the SPR and say war or Katrina or Libya, right? How little that was compared to a non-emergency event that, we drew it all the way down. Now, Biden has said, so this really just showing the magnitude of this SPR draw for literally no reason. But if, Biden did say that he was looking to refill it, at $68, $72, we have gotten down on that in that area. We haven't really been able to stay there, but it is possible that we could be looking at, by our calculations, Q2. They could possibly be looking to repurchase if oil prices are down there, which there's no guarantees, as with China reopening and sort of seasonal tendencies and what have you. Is generally we see about mid-February through summer really starts to kick in higher demand season and you start refining for summer grades and things of that nature. But it is possible that we could see the US, kind of start at least thinking about repurchasing Q2 23. Again, that would, buoy oil prices as well and kind of put a floor underneath it.
Okay, so that kind of reinforces the headline CPI data that I put out there saying, say March, April, May, really things really could tick up. I think it's silly to expect crude to be down at that level, especially as you guys say, if China's opening up, if they're refilling their SPR, if the US is refilling SPR, that sort of thing. So that's all super interesting. Is there anything on energy that we're missing right now, guys? I just want to make sure going into the end of the year that we're covering the areas we need to cover on energy. What are we missing?
So I'll jump in on this just real quick. So
Great.
on inventories, there's a lot of uncertainty. Like Tracy was saying, we don't really know how much oil is in storage in China right now. The way I approach it is just to assume the worst to some extent, to underwrite to that, and then understand sort of upside. And the worst case is somewhat bad. Like it looks like for oil prices, it looks like there might be 200 or 300 million barrels of oil in storage in China, more than some of the most optimistic analytics services or whatever are showing. And so if that's, and it is in theory possible, right? They have big caverns, they could store it like we do. It's possible. To the extent that that's the case, it still might not matter, because as China reopens, to the extent on the low end, again, of Chinese consumption, maybe you get another 2 million barrels a day or so of consumption versus where it's been. And maybe they were importing 1 million barrels a day to store up until this point. So you still have a delta of 1 million barrels a day. And so if you have 200 million in storage, 200 days from now, you're out of storage and you've been importing. You end up with this like 1 million or 2 million barrel a day need to draw on world inventories, but world inventories are really low ex-China. So you end up with a situation where on the low end for recovery, you end up with an undersupplied situation, and that's not assuming any Russia disruptions. On the high end, if you end up with a sort of 3 or 4 million barrels a day, again, what Tracy and Bob were saying about the imports of iron ore and some of these other indicators, if those are right, and we end up on that sort of higher end of demand, which we also saw in the US as we reopened, I mean, things could get crazy real fast, and China could end up looking like the world leader in oil trading from having imported and stored all of this oil to the extent they have it. And then the last thing, oil was in Biden's buy target range, and they were selling from the SPR, not buying it in the last week or two. So that tells me it's very unlikely that there's repurchases of oil into the SPR anywhere close to these price levels and anywhere close to these economic circumstances.
I mean, I think most people agree they probably won't buy back in the SPR, but they say they will. So I think, but I think if that even happens, we're not going to be able, we won't see that until at least Q2, Q3 of 2023. But again, prices are probably higher than where they want them to be to purchase it anyway. But I do lean towards the fact that it's going to be a very long time before they actually start repurchases.
Okay, great.
I have a couple of closing things if I could, because there's, first of all, I mean, I like Josh until he told me he was an economist, but I think that's more of a, strategists. We're like the little, I'm a strategist, and we're like the little brother of economists, and we're always jealous of they get to put the economist behind their name. And strategists, I could just say I'm a strategist. No, I don't have to show a degree to do that. But from a perspective of the SPR, I worry about the future political implications of what the administration did. If you look at somebody sent me the exact definition of what the SPR is supposed to be, and I guess in that context, he used it correctly, right? But I think, I know at least Tracy and I agree that it was used incorrectly here, because it was just a price increase. It wasn't really an emergency. Prices were coming off on their own. Biden's own Treasury put out a report in July that said the SPR release only affect prices somewhere in the range of 13 to 31 cents. And then they revised that from about 28 to 46 cents at the pump. So it wasn't even that big an effect through Biden's own treasury said this. It's not me saying this, but I worry about the future of, prices are up. Let's dump a bunch because we've got, midterms coming. And then next thing you know, there's a massive outbreak of some sort of geopolitical problem in the Middle East, and there's a real emergency and we don't have what we need. So that's my concern about that. The last thing I'd like to say isn't really energy based. It's more about CPI. I was on a Twitter space yesterday waiting for the mic. I never got the mic. And I heard somebody who I won't mention say prices are decelerating at an accelerating rate, when the exact opposite is actually true. Prices are accelerating at a decelerating rate. They're not decelerating at an accelerating rate. People forget, first of all, I don't like the consumer price index, but that's a whole nother podcast. CPI is exactly that. It's the consumer price index. It's an index. If you go to the St. Louis Fed website and you look at a chart of CPI, it's basically always increasing, right? That's why the Fed's target is a 2% increase in prices. If we're in the midst of disinflation, not deflation. And I think sometimes the public doesn't realize, they're like, oh, prices are coming down. No, they're actually not. The rise in prices is actually slowing down, but they're still rising. It's like if you went to buy a car for $22,000, well, I don't know where you'd get that, and you go the next month and it's up $23,000, and then you go the next month, it's up $23,100. Prices didn't go down. They just increased at a slower rate. And I'm going to be saying this everywhere I appear from now on, because I think the public's misunderstanding of what's happening with inflation, maybe I'm going to affect sentiment if I say it too much, Josh. I don't know. But that's the issue I have in terms of CPI specifically. And energy is obviously a huge part of that.
Well, I tweeted out almost the exact same thing this week about CPI and about inflation. And, inflation isn't falling, right? The rate of price rise is slowing. And there's just a huge misunderstanding of that. So before we close up, I just want to, as we go into these last 10 or so trading days of the year, what are you guys thinking about over the next couple of weeks? Is there anything, that's on the top of your mind as the year closes? Josh, let's start with you.
Sure. So people have talked a lot about this. We haven't talked about this yet. The divergence in between oil prices and oil and gas stock prices, especially on the large cap and mega cap side. And I think people forget that commodity prices, other than the spot price, are not predictive. The forward curve is not predictive. It's terrible, right? It's used as a hedging mechanism. It's not used as a prediction mechanism. Equities are forward looking and they're not perfect, but they're one of the best prediction mechanisms that we have. And so energy stocks, oil and gas stocks, are telling us that oil prices are likely to be higher, similar to your analytics software. And the pundits and the sentiment is terrible in saying that oil prices will be lower, and the price has deviated in the short run with the equities. So it does look like the more likely scenario, just even using that heuristic, is that oil prices go higher, again, ignoring all the fundamentals and whatever. And so the interesting thing is, if that's right and oil prices go higher, it might send those oil and gas stocks even higher, right? There's sort of this sort of Soros reflexivity that happens with those sorts of things. So I think it's worth touching on. It's many people are posting about it, talking about how they need to converge, and I just think you got to understand what they are and what they aren't. That's
a good point. Tracy, what are you thinking about going in the last 2 weeks of the year?
I was just gonna say that chart is everywhere. I just I'm just trying to get through the end of the year, to be honest. I'm still looking very closely at open interest in the gas market, the oil and gas market, oil in particular. A lot of length has come out of that contract because people just aren't interested. A lot of people took profits because it was one of the more profitable commodities, right, over the last year, 2 years. We haven't really seen anybody actively short that market. Short open interest has actually declined a little bit, but not as much as length. So if people get interested in this market again, there's a lot of room to the upside if people jump in, because that length has been taken out of the market. So, I'm watching that towards the end of the year, in particular, see what happens after the beginning of the year and see if this market can, find some more interest.
Okay, all three of you are being pretty subtle about your expectations for energy prices. I'm trying to see it. So Bob, why don't you close us out? What are your expectations going into the last 2 weeks of the year?
So first of all, I agree. I think I shouldn't say this, but I think there's almost no way energy prices continue lower on the crude oil side, and natural gas is doing what natural gas is going to do. So I think overall energy prices go up, electricity prices are going up. And given that backdrop, if the three of us are right, by the way, if I mischaracterize what you two think, please jump in. If energy prices go higher, there's very little chance, in my view, that of the three possible scenarios for the Fed, that the right one can come true in the Fed's view. So I'm actually more looking at EPS estimates for equities need to come down, earnings estimates need to come down, and the Fed is either going to have to A, admit to a higher inflation target, or B, accept a higher level of inflation without saying so, or equities have to make a new low. And when that low happens, if that low happens, I should say if, it's a very good opportunity for industrials and consumer staples to sort of get in and kind of ride the recession wave back up as the economy itself restrains inflation by us going into some sort of a shallow or deep recession. The other two things I would say, is there any way I can get an economist title without putting in the work that Josh did? If anyone knows how to do that.
Absolutely. Just put it on your bio.
Yeah, Josh, don't let me do that. You actually worked for it. And then the last thing I would say, if anybody wants to send me a bottle of Blanton's, I'm willing to give you a free trade that is guaranteed to either make or lose money.
Perfect. Hey, Bob, just kind of latching on to what you just said about energy prices rising and industrials. So we've seen through 2022, a lot of industrials and retail firms raise price, okay? And consumers have accepted that price. But if you're saying that commodities are generally going to rise, and
Yes.
Does that mean that we'll see margins compress for those industrials? Okay, so
in the short term,
feel like consumers are at a threshold where they can't accept higher prices soon.
So if you guys remember, you look back to the Great Recession in 2008, the last thing people did was let their car be repossessed. That kind of shows you the inelasticity of energy demand in general. People were defaulting on their mortgages before they let their car payment go into default. So from that perspective, people might be overestimating how far demand for energy can drop even in a recession. I'm making a correlation that probably isn't accurate, but just anecdotally, that's something that we've seen. And it's the same thing with heating and cooling your home. People are probably less likely to stop heating their home. They're probably more likely to accept cooling at a little bit hotter of a temperature. So going into summer, it may not be as apparent. But I do think that when we come out of it, industrials, utilities, energies, and consumer staples are going to lead us, as most times coming out of recession, simply because they're the first things that people start spending again on, and they're the last things that people stop spending on. So I like those things coming out of what I expect to be a fairly decent drop in end of the first quarter, beginning of the second quarter next year.
Very good. Guys, thank you so much. I really appreciate your time. This has been fantastic. So have a great weekend and have a great week ahead. Thank you.
Thank you.
Cheers, guys.